Good afternoon, ladies and gentlemen, and welcome to the Space and People PLC interim results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so, and these will be available via your Investor Meet Company dashboard. Before we begin, I would like to submit the following poll, and I would now like to hand you over to the executive management team from Space and People PLC. Nancy, Gregor, good afternoon.
Good afternoon.
Good afternoon. Hi there, everybody. I was going to start with a short introduction to Space and People for those of you who don't know much about the company who may have joined this for the first time. So I apologise to regular investors, but this is just a quick run through about Space and People as it is today. So it's a business which is nearly 24 years old, revenues of 5.5 million in 2022. Fully in-house, providing a complete service for property developers who want to outsource their commercialisation. We're market leaders in terms of the sale of promotional space, and we represent the majority of high footfall venues across the UK. We're also market leaders in the provision of high value experiential activity and that we put into our properties, and we aim to concentrate and grow that every year. I think we're unique in that we have a full operations division, a warehouse and a team of staff who deliver, install and maintain units on behalf of our property partners. And everything that we put into our venues is subject to a huge amount of due diligence and compliance. And we've got ISO accreditation to that effect. And as you know, we're listed on the London Stock Exchange, and therefore we have full independent auditors' accounts. And essentially, we're Europe's largest agency supplying promotions into the retail and transport sector. And if I can just move on. So just talking through a few of our premium venues, you've probably heard of some, if not all of these. Meadowhall in Sheffield, Metro Centre in Newcastle, Waterloo Station, King's Cross Station, Victoria Station, St David's in Cardiff. So a lot of major venues represented by the Space and People service. And this is what we're set up to do. 40% of what we do is in this area. I hope you can see my cursor because I'm circling the brand experience side. That is major one-off brand activations, road shows that go up and down the country, and major sampling campaigns. That's 40% of what we do. The other 40% of what we do is retail, and that can be long-term retail on kiosks, mid-mal, or it can be pop-up retail. And the pop-up retail can either be in units supplied by the operator or, and we'll talk a lot more about this, our rock-up and pop-up service, which is a complete service for new retailers. And then a further 20% of what we do is local customer acquisition. We'll talk a bit about that. And then we also do some contract management, which is vending and digital advertising. So just to tell you a bit about brand experience, in the year that we're talking about, 2023, last year we launched our Experiential Space website, which is a website for agencies who want to find out more about our venues. We further enhanced that this year by offering live availability calendars on that. And just to show you the sort of brands that we're activating for at the moment, this is the brands that we've booked so far in 2023. And I'll flick through this. I don't want to take too much of your time, but as you can see, a huge number of major high-profile brands, often doing specific launch campaigns to support their advertising. When we talk about retail, as I said before, there are two types of retail. There is pop-up retail where a retailer supplies their own stand, and these are just a few of the brands that have their own stand and book regularly into venues on our service. As you can see, they can be major UK retail brands or slightly less well-known brands, but still with a huge network and willing to invest in kiosks to activate and sell their products. Our new service is Rock Up and Pop Up. And this is a service where we supply the kiosk and we supply everything to do with that kiosk. We install it, we do all the graphics for it, We do the merchandising, we do the marketing planning, we do the business planning, and we even provide the staffing via an agency if that's what the retailer required. And this is allowing us to put into venues what we believe venue owners, well, we know venue owners want, which is new and different and online retailers. And the whole idea of this service is to put retailers on the first step of the escalator into major footfall venues, going from being a startup retailer in a venue to perhaps going on and investing in their own kiosk, or even going into a retail unit in the long term. And this has been very much the focus of the business over the last sort of 6-12 months, is getting this business up and running. And finally, just to say, we don't just drive sales via our sales office. We do it also in a variety of methods, but with an awful lot of online reach out using Instagram, TikTok, etc., talking to new retail businesses. So that's a bit about the company. I think we're now going to go on and talk about our results. I'll just as an introduction to that, just to say this first 6 months has been a period of development for the company. We've been investing in staff. We've increased our London base and our brand experience team. We've also looked at our operations team, and we're reinforcing that. We've been looking at new systems and investing in new systems. We added the live availability onto our experiential space website. We've also been looking at new financial management systems. And we've been very product focused, out with the old, which is the RMU that we used to put into UK shopping centres, and very much focused on the kiosk, which we manufacture in Germany, and the rock-up and pop-up business, which is having good traction and looks set to grow and grow. We've also got our eyes on international expansion. So I'll let Gregor kick off with the financial highlights.
Okay, thank you, Nancy. Hello, everyone. I just thought I'd pick out some of the financial highlights from the report, and feel free to ask any questions you want about them. The first thing is net revenue went up about 5% in the first half year compared to last year. It's principally as a result of good growth in our German division, where we were up 38% on last year, being offset really by a decline in our UK retail, where we're in a bit of a transition period, which I know Nancy will come on to talk about more on the rock-up and pop-up side. The UK promo side of things was roughly flat, just a slight increase in our revenue there. This is usually and will be the lower half of the year in terms of our revenue. Revenues are higher in the second half of the year, so pretty much in line with what we had expected and forecast the first half to look like. That has meant that operating losses have in the first half year have been roughly equivalent to last year's as well, with a slightly higher gross margin than we had in the previous year. But we've invested more in recruiting sales staff with a view to driving revenue in the second half year, and we also had some overheads that we had increased in the first half just through inflationary pressures, really. When you look at our cash position, we had a significant cash outflow in the first half year. When we did our full year results, we announced in them that our cash position was looking pretty good compared to where we'd have expected it to be, and that was because we owed a lot of money to one of our clients who hadn't invoiced us as at the year end. They invoiced us shortly after the year end, and we paid that out in full, hence the significant cash outflow, which was expected. In terms of where our cash is at the half year end, and since the half year end through until last Friday, we continue to have decent cash balances, plenty of cash headroom for us to be able to conduct the business. And the analysts have also updated where they think our year-end cash position will be, which they've blipped up from about 500,000 of cash to about 1 million of net cash at the year end, just due to where we think our working capital will be and it being better than we'd anticipated initially. We continue to pay down the CBILS loans that we took out in line with the lending agreement, and that's at roughly £323,000 a year that we do that, and we are complying with all of our covenants in relation to that.
Okay, so just running you through the operational highlights, which I alluded to earlier. As I said, we're going through a transformation in our UK retail division. We recognised that post-COVID, there are an awful lot of online retailers struggling to get a share of voice in a busy online market. And that was what created the idea of Rock Up and Pop Up, which is a complete retail solution at every single level, meaning that a retailer, an online retailer, can turn up with a box of products and we will basically turn that into a business. And on the left-hand side of the screen, you'll see a company called Just Be Honey at the Trafford Centre. That was a pure play online business selling vitamin honeys and Manuka honey, never done any physical retail before. And we set up their kiosk, did the branding for their kiosk, did all their merchandising. And they're now looking to trade in 5 venues with us over Christmas. So just goes to show that if you offer people a solution in a market rather than just a product, that actually they will buy it. Another operational highlight was the strong performance in the German retail division. A 38% increase in the average number of occupied units led to the similar increase in revenue. And obviously, we announced last week that our Network Rail agreement has been extended for another year, which we're obviously delighted about. So just talking about the UK performance, a revenue increase of 4%. The retail business is very stable and good. Brand experience, we had a very good H2 last year on brand, and we're still getting to grips with brand in the post-COVID environment. This first half of the year has been lower than we wanted it to be, and slightly lower than our expectations. However, we have seen in the last few months brand experience come back, and we're beginning to think that this is now a trend, that we will have a sort of poorer H1 on brand, but actually a very strong H2 in this sector. If we look at the retail revenue, that is revenue where we supply the kiosk. That is mainly because the charity utility company market that we put onto our own units has been a bit depressed recently, particularly utility companies, but we're hoping that will come back. But also, obviously, we are phasing out our old RMU kiosks in the UK and looking to relaunch with Rock Up and Pop Up. We had 10 kiosks, 10 retailers trading between January and June, and we're looking to more than double that in the run-up to Christmas. When we look at German performance, as Gregor said, retail revenue increased by 38% to 0.8 million, and the average number of kiosks up as well. The profitability looks very much like last year, but this year we didn't have any central government support, so it's actually a better performance. And very much with the German business, we're looking to expand it out of Germany. We started trading in Austria with ECE at the end of last year, and we're still trading on 2 retail units in Zeesburg. And we've just signed a new trading agreement with Multi in Germany. We're in 2 of their centres, and there are a further 10 that we're interested in. And we're also in advanced talks with a number of other operators in the sort of Benelux countries. So looking at outlook, obviously we're looking for growth in our UK retail business. Our Rock Up and Pop Up kiosks are currently in a number of major shopping centres. I'm talking about both of the Westfields, Trafford, Lakeside, Braehead, Meadowhall, Metro Centre. And we're looking to expand that further. There is endless demand for this product. It's all about finding the right product for the right venue. We are looking at further European expansion. We've started trading in Austria, but there are obviously plenty of additional territories we could grow into using our German base as the focus for that. And obviously, as I said before, we're delighted that we've retained the Network Rail business, but we're really looking to grow that business further and faster over the next 6-12 months.
Okay. Nancy, there's been a number of questions submitted, so I think this might be a good time for us to go through these. If I can read them out and then we can decide whether you or I would like to answer them. The first one, which was pre-submitted this morning, was what impact are the current train strikes having on the business? Also, are lower post-COVID train passenger numbers and hybrid working making train stations a less desirable marketing location?
Shall I take that one?
Yes.
So yeah, the train strikes did have a bit of an impact in Q1 on our business. It may explain the slightly depressed brand experience numbers. Lower post-COVID train passenger numbers is interesting. Yeah, the pattern has changed. The numbers I don't think have changed significantly. So whilst we had a very strong Monday to Friday and a much poorer Saturday and Sunday, the whole pattern's kind of evened out, which does actually make them equally attractive to agencies. You're right, it's a different pattern, but it's not a depressed pattern anymore. In fact, train stations are looking very vibrant again.
Okay. The next question was, the Network Rail extension was great news, but you were hoping for a multi-year deal. Have Network Rail given any steer on future contract lengths or why they are only renewing annually?
No, they haven't. We're assuming that at some point there will be a tender, but we're happy enough that our good relationship with Network Rail has been extended for another year. I'm sure there will be a tender process. I know we're in line to go into tender, but they've got a number of other contracts that they're pitching at the moment. So ours will come up in due time.
Okay. The next question is probably one for me to answer. It's, what are your major CapEx plans for the near term? Well, in terms of the near term for the remainder of 2023, our only significant CapEx is building and buying more of the rock-up and pop-up units for us to roll out this throughout the UK and Germany during the second half of this year. It's not a major capital expenditure amount. The payback period is relatively short, and we're also only really committing expenditure on them when we have committed contracts for people to want to occupy them. We're not building them speculatively. In the medium term, we anticipate spending next year on improving and further developing our systems, both client and promoter facing systems for our booking system, and also refining some of our back office systems as well, just to make things run much more efficiently, just as software technology develops. They're in the pipeline. Again, nothing which is massively expensive for us to do. We see that the growth of the business can be sustained without significant CapEx expenditure. We see our major expenditure requirements as the top line grows, actually just employing more sales staff to deliver the additional revenue. The next question was, UK retail revenue declined by 23%. Do you see this trend reversing anytime soon?
Do you want to take that one, Greg, just to explain the difference between retail revenues and, dare I say it, retail revenues?
Okay, so one of the important things to remind people about is that there's two different revenue recognition policies in our financial statements. When you look at the segmental analysis and you look at promo, that is just our net commission that's shown in there. It's not the gross sales level in terms of what we pay over to the venues. When we look at the retail side, both in the UK and Germany, this is very much our gross revenue, and then we pass over a proportion of that, depending on our contract, through a cost of sales to the property owner. So that probably overstates the extent of retail if you're trying to do a straight comparison between promotions and retail. However, when the question still remains, it's a 23% decline. Do we see that reversing anytime soon? We have a significant expansion of our rock-up and pop-up offering proposed for H2 of this year and then into next year as well. So we do see that turning around very quickly, probably in the next month or so. That will start to increase quite significantly again, getting back to where we were and beyond that in the rest of this year and into next year. Next question is, what is your key financial performance indicator this year? Well, the key financial performance indicator for us, well, there's a couple of them. One is returning to profitability after a few years that have been severely affected by COVID. We no longer have any government support helping us like every other company out there. So this is back to how we are able to trade ourselves. So both in terms of looking at an EBITDA level and profit before tax level, our aim is to get back to a positive profit before tax rather than a loss before tax for the full year. The other one is getting in a position where we are eliminating our net debt and ending the year with a significant net cash balance in the business, which isn't there as a result of owing a major client money. It's actually our working capital facility itself. And then the next question that came up was, what are the remaining CBILS loans and over what time frame are they? Well, you can see in our results in our balance sheet that both in terms of short-term and long-term loans, we're repaying CBILS loans at a rate of about £322,000 per annum. As it stands just now, we've got 322,000 in the short-term borrowings, and then there's roughly just under £1 million remaining in the long term. So about 1.3 million to go out of the 2 million that we had. We also had CBILS overdrafts, or have CBILS overdraft facilities of an additional £750,000, but they remain unutilised and have remained unutilised, just as additional headroom should something untoward happen, just to give us some leeway. But that gives us quite a lot of cash headroom. These two are repayable by roughly 2026, 2027. And in the full year results, there's a bit more analysis of what those amounts are and when they're repaid. The latter one, the second £1 million loan that we had, we're repaying at £25,000 a quarter, and there's a £500,000 balloon payment at the end of that, which we would look to pay off as it becomes due. The next question that was, current liabilities remain significantly greater than current assets. Is this sustainable? It is sustainable just in terms of the way that our business works, where we do our invoicing and cash collection for businesses. We can afford to pay all of our commitments to venues as they become due. If we're collecting money earlier, then that's fine. That's why that shows as a current liability. The headroom that we have allows us to sustain that as well. We are not behind in paying any of our current liabilities just now or future liabilities, so we're pretty comfortable with that. The next question, Nancy, is how much visibility on bookings do we have going into Q4?
We've got good visibility on the retail side of our business. That is retail kiosks and rock up and pop up. We have to have visibility on rock up because obviously there's a logistics side of that. On the brand side, we are beginning to get clarity on that. I have to say the brand business does book late, and I don't know if any of you saw Martin Sorrell's comments last week about the advertising market, saying it has gone very tactical. That is true. Having said that, we have got sight of quite a lot of our Q4 revenue. So yeah, we are probably seeing about 75% of it at the moment.
Okay, and then another question, Nancy, is 2 units plus potential of another 10 sounds very encouraging. This is in relation to the multi-contract. Are you able to expand yet on the financial side of the multi-agreement? Could it be a material addition to revenue in the coming years? Do you want me to answer that? Just in so this is at quite an early stage where multi are just seeing how it works with them. We see the sites as working well just now, and we would like to expand with them, but there's nothing firm in the current sales pipeline. If it were to expand out to 10 to 12 sites with potential for multiple units at each site, then it would be a material addition to our revenue in Germany. But we are also looking at a number of other German property companies out there who we would hope to add as well. ECE remain the dominant player in the German market due to their own property ownership and the malls that they manage on behalf of other people. So that's the key central relationship. But everything else that we can add to that certainly would be beneficial. And we don't have, we will have to employ more staff as we win more contracts, which is a success problem to have. And we're in the process of looking for some additional staff just now in Germany. But anything that we add to the revenue in Germany will have a very positive impact on the profitability of that business, whether it be from multi or any others. So we are very focused on growing that German business over the coming months and years. I think that's all of the questions that we had. Nancy, would you like to just summarise?
Yeah, so this is our first year of proper trading post-COVID. It's great to be running a company which is in a market which we're now beginning to understand. It's been great spending this the first 6 months of the year developing products and developing our systems, etc. It is an exciting time to be an established company with relevant and exciting new products and with an international base, I suppose would be the summary. There are lots of things that we can do moving forward.
Nancy, Gregor, if I may just jump back in there, and thank you very much indeed for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This won't take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Space and People PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.
Thank you.
Thank you.